Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. For more information, visit CambriaInvestments.com.
Today we have a fun episode titled, "It Might Be Time to Rethink Your Dividend Strategy." Let's dig in. Many investors are drawn to dividend-paying investments, and it's easy to see why. Investors fantasize about sitting in a beach chair, pina colada in hand, while passive income rolls into the bank account. There are limitless strategy permutations for how to invest in dividend-paying stocks. The two main flavors tend to be dividend income and then dividend growth. In their recent report titled "Searching for Great Dividend Funds," Morningstar calculates there are 348 open-ended mutual funds and ETFs with over $1 trillion focused on dividends. At a hypothetical 3% dividend yield, that $30 billion in cash dividends buys a lot of pina coladas. Now, continuing on in their research article, Morningstar sets out to find some of these great dividend funds. However, there's a big problem. We believe they're looking in the wrong place. Over a decade ago, we tackled this exact topic in our book, Shareholder Yield, A Better Approach to Dividend Investing. The basic thesis was that due to a structural shift in markets, companies altered how they distributed their cash to investors. While a majority of companies used to return cash to shareholders predominantly via cash dividends, starting in the 1990s, companies shifted to only distributing a minority of their cash through dividends. What took their place? Stock buybacks. Now, stock buybacks tend to get a bad rap. The thesis of the Shareholder Yield book was that a more holistic approach, incorporating both cash dividends and net stock buybacks, was a superior way to sort and own stocks. It's important to include share issuance in the net stock buybacks equation, as many companies consistently dilute their shareholders with share issuance, often due to stock-based compensation. The book found that in historical simulations, a shareholder yield approach was superior to investing in the broad stock market, as well as investing based on dividend income or dividend growth strategies. Since anyone can develop a beautiful-looking historical backtest, a key test of robustness is how a strategy performs over multiple market cycles out of sample in real-world trading. In May of 2013, we launched the Cambria Shareholder Yield ETF, ticker symbol SYLD. We now have over a decade of real-time data to examine the question, how did shareholder yield perform relative to the universe of hundreds of dividend strategies? To help us frame this, we replicated the methodology of the Morningstar study, and to be more comprehensive, included strategies that were focused on stock buybacks as well. This totaled 188 funds with live performance from SYLD's inception of 5/14/2013 all the way to 12/31/2023. Now, this does not include all the funds that closed over the period, which is often due to poor performance. A decent rule of thumb is that about half of all funds close or are merged over the course of a decade. So, how did SYLD perform relative to this large universe of dividend and buyback funds? SYLD outperformed all of them, every single one. At a 12.91% return since inception per year, SYLD sat at the top of every single dividend strategy. It didn't matter if the strategy was focused on high yield or high growth, and it didn't matter if the strategy was actively managed or passive. SYLD outperformed them all. Now look, we don't say this to gloat, nor would we expect SYLD to be the number one performer again, although we can hope. Rather, we believe it's a helpful way to evaluate the concept of a holistic approach to income that is not limited to dividends alone, and we feel the strategy is one that has merit. For more information on the Cambria Shareholder Yield ETF, SYLD, please respond to this podcast, info@CambriaInvestments.com, or reach out to us at 310-683-5500. Thank you and good investing.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.
Disclaimer. The article mentioned in this piece was called The Search for Great Dividend Funds, What Separates the Best from the Rest by Morningstar in December 2023. To determine if this fund is an appropriate investment for you, carefully consider the fund's investment objectives, risk factors, charges, and expenses before investing. This and other information can be found in the fund's full and summary prospectus, which may be obtained by calling 855-383-4636 or ETF Info, or by visiting our website at www.cambriafunds.com. Read the prospectus carefully before investing or sending money. The Cambria ETFs are distributed by Alps Distributors, Inc., 1290 Broadway, Suite 1000, Denver, Colorado, 80203, which is not affiliated with Cambria Investment Management LP, the investment advisor for the fund. ETFs are subject to commission costs each time a buy or sell is executed. Depending on the amount of trading activity, the low cost of ETFs may be outweighed by commissions and related trading costs. There is no guarantee that the fund will achieve its investment goal. Investing involves risks, including the possible loss of principal. High-yielding stocks are often speculative, high-risk investments. The underlying holdings of the fund may be leveraged, which will expose the holdings to higher volatility and may accelerate the impact of any losses. These companies can be paying out more than they can support and may reduce their dividends or stop paying dividends at any time, which could have a material adverse effect on the stock price of these companies and the fund's performance. International investing may involve risk of capital loss from unfavorable fluctuation in currency values, from differences in generally accepted accounting principles, or from economic or political instability in other nations. Emerging markets involve heightened risks related to the same factors, as well as increased volatility and lower trading volume. Investments in smaller companies typically exhibit higher volatility. Narrowly focused funds typically exhibit higher volatility. Dividends are not guaranteed. Companies paying dividends can stop paying dividends without notice. Copyright 2024 Morningstar Inc. All rights reserved. The information contained herein, 1, is proprietary to Morningstar and or its content providers, 2, may not be copied or distributed, and 3, is not warranted to be accurate, complete, or timely. Neither Morningstar nor its content providers are responsible for any damages or losses arising from any use of this information. Past performance is no guarantee of future results.